According to a brokerage report by JS Global, inflation in Pakistan is expected to reach a record high of 37% in May 2023. This surge is attributed to increasing costs of food, energy, and other goods, making it the highest inflation rate in the region. In April 2023, the Consumer Price Index, CPI, was recorded at 36.4%, up from the previous month's 35.4%. The report predicts that the recent decline in petroleum prices will not affect May's inflation readings, as rising food prices will drive inflation even higher. The report highlights that food inflation is expected to reach 47.99% year-on-year in May, with a month-on-month increase of 0.81%. Although this monthly increase is lower than the previous 4 months, it will contribute to the overall inflation. Non-food, non-energy inflation is also expected to reach a record high of 30%, with a month-on-month increase of 2.7%. Specifically, tobacco inflation is projected to increase by 122.3% year-on-year in May, followed by recreation at 64.1%, transport at 52.6%, food at 48%, furniture at 42.3%, restaurants at 40.6%, and clothing at 28.3%. The overall headline CPI for the first 11 months of the fiscal year 2023 is estimated to be 29.03%. Pakistan has been facing political and economic challenges, including a balance of payments crisis, delays in the IMF bailout program, and the state bank raising interest rates to a record 21% to control inflation. The country's currency, the Pakistani rupee, has depreciated significantly, and the economy relies on foreign investments and continued IMF support. Although Pakistan recently posted a current account surplus, it has come at the cost of import restrictions, resulting in production cuts, job losses, and an economic slowdown. The weekly inflation in Pakistan decreased by 0.16% compared to the previous week, but increased by 45.72% year-on-year. The federal government's reduction in fuel prices contributed to the weekly decline. The Pakistan Bureau of Statistics collects short-term inflation data from 50 markets in 17 cities, including prices of 51 essential items. During the observed week, prices of 23 items increased, 13 items decreased, and 15 items remained unchanged. Overall, Pakistan is grappling with high inflation rates driven by rising food and energy costs, a weak currency, and economic challenges that require sustained efforts such as the IMF bailout program and foreign investments to revive the struggling economy. New data from the Federal Reserve reveals that Americans' financial health deteriorated significantly in 2022 due to elevated inflation. According to a survey conducted by the central bank, the proportion of U.S. adults reporting that they were financially stable decreased to 73% in 2022, down 5 percentage points from the previous year and one of the lowest levels since 2016. Nearly one-third of respondents said they were either barely getting by or finding it difficult to meet their financial needs. The survey, which collected responses from over 11,000 individuals in October, found that 35% of Americans felt worse off financially compared to the previous year, marking the highest level since the question was first asked in 2014. The Federal Reserve attributed this decline in financial well-being to relentless price pressures, which led consumers to reduce their spending on certain items or switch to cheaper alternatives and forced them to tap into their savings. The decline in financial sentiment occurred as the Federal Reserve implemented its most rapid tightening of monetary policy in decades to combat persistent high inflation. Throughout 2022, the central bank increased its benchmark interest rate from near zero to nearly 4.5%, frequently employing significant 0.75 percentage point hikes. Despite additional rate increases in 2023, including a quarter-point rise the previous month, policymakers are now deliberating whether to halt further tightening at the upcoming policy meeting in mid-June. Many policymakers express concerns that inflation has not significantly receded despite indications that price pressures have peaked. hiring by employers and conservative consumer spending, though less robust than the previous year, contribute to worries that the economy still possesses excessive momentum. Uncertainty surrounding the ongoing credit crunch, prompted by multiple bank failures since March, further complicates the economic outlook. Federal Reserve Chair Jay Powell mentioned this concern on Friday and suggested a potential preference for postponing another rate increase in June. Mary Daly, president of the San Francisco Fed, remarked on Monday that the recent credit tightening is comparable to one or two rate increases, but stated the need to closely monitor data to confirm this estimation. The Federal Reserve survey also indicated a decrease in the number of Americans who could cover an unexpected $400 expense using cash, savings, or a credit card that could be paid off immediately. Only 63% responded affirmatively, compared to 68% the previous year. Approximately 10% said they would not be able to cover the expense using any means. Furthermore, 18% stated that their savings could only cover expenses under $100, while 14% indicated a limit of $499. Daniel Pinto, president of J.P. Morgan Chase, issued a warning that the U.S. economy is likely to enter a recession as the Federal Reserve attempts to tackle surging prices, which he described as terrible for society. As the deadline for raising the U.S. government's debt ceiling approaches, Wall Street banks and asset managers are preparing for the potential fallout of a default. The financial industry has previously dealt with such crises, but the short time frame for reaching a compromise is causing concern among bankers. If the U.S. were to default, it would likely lead to massive volatility across equity, debt, and other markets. Trading in Treasury positions would be severely affected, spreading dysfunction to derivative, mortgage, and commodity markets. Interest rates could spike, equity prices could plummet, and loan agreements could be breached. Short-term funding markets would also freeze up. Banks, brokers, and trading platforms are preparing for disruptions to the Treasury market and broader volatility by planning how to handle payments on Treasury securities, ensuring sufficient technology and staffing capacity, and assessing the impact on client contracts. Institutions are considering various scenarios, such as the Treasury rolling over maturing securities to buy time for payment, or a more disruptive scenario where the Treasury fails to pay both principal and coupon. Industry groups like the Securities Industry and Financial Markets Association, SIFMA, have developed playbooks for communication and coordination among stakeholders in the Treasury market. The Treasury Market Practices Group and the Depository Trust and Clearing Corporation are also monitoring the situation and have plans in place. We provide customized tenders, websites, social media, and legal consultancy. Call or WhatsApp 92-302611-1222.